Gold just had its worst week since 1983. Not its worst week this year, not its worst week this decade. Its worst week in over 40 years. Spot gold sitting at $4,762, down roughly 9% in a single week, silver down more than 10%. The S&P 500 on its longest weekly losing streak in a year. And here is the part that does not make sense on the surface. All of this happened while an active war was running in the Middle East, the war that was supposed to be the strongest possible argument for owning gold. The war that had been pushing gold to record highs just weeks ago. That same war is now the reason gold just posted its worst week in 40 years. So what changed? And why is the war that launched gold now the thing that is breaking it? Stay with me, because the answer is not what you think it is. The easy explanation goes like this. Oil is spiking because of the war. Oil spikes feed inflation. Inflation makes the Fed nervous. A nervous Fed does not cut rates. No rate cuts means higher yields. Higher yields mean the dollar stays strong. A strong dollar pressures gold. Gold falls. That chain is real. Every link in it is valid. And most of the financial coverage you will read this week will give you exactly that explanation and stop there. But there is a layer underneath that explanation that is more interesting and more uncomfortable. Because that chain, oil up, Fed freezes, dollar wins, gold falls, is not new information. That logic was already visible 2 weeks ago, 3 weeks ago. The market knew the war was inflationary. The market knew higher oil would complicate the Fed's job. Gold should have been pricing this in gradually. Instead, gold held its gains. Then it dropped 9% in 1 week. Something specific happened. Something that crossed a threshold. And that something is sitting in one number from the Fed this week. The Fed released its dot plot, the updated projection for how many rate cuts are coming in 2026. The number came in at 1, a single rate cut for the entire year. But here's the part that is not getting enough attention. Traders are now pricing a coin flip chance of a rate hike instead of a cut. Not no cuts. A hike! Think about what that means for gold, and think about why this week specifically was the week the market finally priced it in after weeks of ignoring the same underlying logic. We will come back to that. But first, there's something else happening in the data that almost nobody is talking about. Gold declined for 7 consecutive sessions. 7. That is not volatility. That is a trend. And on the 7th session, spot gold hit $4,741, down 3.7% in a single day. Silver down 4% the same session, over 5% across the week at that point. At the same time, the Bloomberg Dollar Index fell 0.7%. Hold on, the dollar fell, and gold fell with it. Gold and the dollar falling simultaneously is not the standard playbook. When the dollar weakens, gold typically gets a lift because it becomes cheaper for foreign buyers. That inverse relationship is one of the most reliable patterns in commodity markets. When both fall at the same time, it usually means one thing: forced selling, liquidation, investors who need cash, regardless of price, regardless of the relationship between gold and the dollar, regardless of the war, regardless of anything else on the board. This is the signal that most coverage missed this week. The simultaneous decline in gold and the dollar is not a clean macro story about inflation and the Fed. It is a story about margin calls, redemptions, and a market under financial stress that is selling what it can sell rather than what it wants to sell. So here is the question that matters now. If some of gold's decline this week was forced selling rather than a fundamental reassessment, does that mean the selling is temporary? Does it mean gold recovers when the liquidation pressure exhausts itself? Or does the forced selling reveal something real? Does the fact that gold could not hold its gains even with a war running tell you that the safe haven case was always thinner than it looked? The answer depends on something we do not yet know. Here is the uncomfortable reframing of this week. The war launched gold higher because it was supposed to be inflationary and destabilizing in a way that hurt paper assets and benefited hard assets. That was the thesis. Geopolitical chaos, supply disruption, dollar uncertainty, buy gold. But the war has now run long enough to change the Fed's calculus. The dot plot, showing one cut in 2026, is a direct response to an inflationary environment that the war is actively making worse. The coin flip odds on a hike are a direct response to oil supply disruptions that are keeping energy prices elevated in a way the Fed cannot control with interest rates. The war created the inflation that created the hawkish Fed, that created the high yields, that created the opportunity cost that is now actively working against gold. The war did not stop being a gold argument. It became a gold headwind. The same event is now pushing gold in 2 directions simultaneously, and this week, the headwind won. Gold's worst week since 1983 happened not despite the war. It happened partly because of it, and this brings us to the question that nobody can answer cleanly right now. The Fed revised its dot plot to 1 cut for 2026. That projection was made with current oil prices and current conflict conditions as the baseline. But what happens to that projection if the conflict intensifies further? What happens if oil moves materially higher from here? What happens if the inflation data that comes in over the next 2 months, data that will capture the full supply shock effects of the war, comes in above what the Fed was projecting when it published that dot plot? Does the Fed move from 1 cut to 0 cuts? Does the coin flip chance of a hike become the base case? And if it does, what does gold do? That is the question sitting underneath this week's 9% decline. Not whether gold is dead, not whether the war matters anymore, but whether the macro sequence that was supposed to make gold unstoppable has now run into a scenario where the same war that launched gold is keeping the Fed too hawkish to let it run. Gold stabilized toward the end of the week. Futures up 1.2% at session end Friday. Spot gold at 4,062 with a 0.3% recovery. The worst of the selling may be done for now, but stabilization is not the same as resolution. The dot plot still says 1 cut. The oil supply disruption is still real. The inflation that the war is generating is still flowing through the data. And the Fed's own language this week highlighted inflation risks that are not going away quickly. Gold's worst week since 1983 is now in the record books. What the next week looks like depends on whether the forced selling has exhausted itself, whether the oil price gives the Fed any room to soften, and whether the data that comes in over the next several weeks confirms or challenges the hawkish dot plot projection. None of those questions have answers yet. And that is exactly the environment that makes the next move in gold the most important price signal in the market right now.